If it felt like you were paying more for petrol and your fruit and veg over the last few months, you weren't wrong. Australia's inflation rate has spiked, partly because of the bad summer weather. Figures just released show that the March quarter consumer price index has come in at 3.3% for the year and comfortably high for the RBA. And the rise for the quarter is a strong 1.6%. Well, Bill Evans is Chief Economist with Westpac and he joins me now. So, Bill Evans, are you worried by these numbers?
Ros, yes, they were more than we expected. We're expecting 1.2 on the headline, but more importantly, the underlying measure that the Reserve Bank follows most closely, we're expecting 0.7. That printed 0.9. And that means that the underlying number that printed 0.4 last quarter is now at 0.9. That's a big jump. We think there is some seasonality in that, but that's still a signal to the Reserve Bank that they need to maintain their tightening bias.
So when do you expect the next rate rise to be?
Oh, Ros, look, we've expected that the next rate rise will be in the September quarter, mainly driven by the strong labour market and the fact that the unemployment rate has now fallen below 5%, which is where we think the Reserve Bank sees the danger sign. So this number, which before today the inflation numbers had been quite constructive for them, it was really only concerns about wages in the labour market that were the factors. Today we've now seen inflation also become a factor that they'll need to be concerned about.
So if it's not just seasonality behind the pressure, where is the pressure coming from?
Well, the major components that were stronger than we expected were firstly food. That printed 2.9%. We're only expecting 2.2. And fruit and vegetables were more than we expected. But you can understand that the weather factors were played havoc with forecasts there. But we saw alcohol and tobacco were up much more sharply than we expected. We're expecting a fall there. And also financial services were up almost double what we were expecting. And so they're the things that led to the difference between the market expectation of 0.7 and the number of 0.9. Now, that might not seem too much, but when it's coming off a 0.4 last time, it's enough to unnerve the central bank. And
this is not just putting more pressure on interest rates, of course, it's also putting pressure on the Australian dollar, 108 US cents now.
108.5, Ros, after today. It entered the figure around about 108. What we have to remember, however, is that since the Aussie got to 105, it's mainly been a weak US dollar story. About 80% of the strength in the Aussie going from 105 to 108 has been direct US dollar weakness. And we do believe that with the Federal Reserve withdrawing their money printing process during June, that should provide some support for the US dollar. So I'm certainly not in the camp that says the Aussie dollar is going to the stratosphere from this point.
So a rate rise in September, where to for the rest of the year and early 2012?
Look, I would expect only one rate hike this year. I think the cautious consumer and the weak housing sector are still very much major factors for this economy. Higher rates and a higher currency are just going to put more and more pressure on those sectors, but the Reserve Bank at the end of the day will be watching the labour market, the wage pressures, the mining boom, and of course now some concerns about inflation.
Bill Evans, thank you.
Thanks, Ros.